Solange Charas and Jaylen Spann, and they're going to be talking about calculating the financial impact of DEI. So we're going to be going from more academic conversation to a very practical conversation that impacts businesses writ large. So if we can please spotlight the two presenters, and I see that both of them are here. And if you can take yourself, you're perfect. Solange, hi, nice to see you. And there we go. And where's Jaylen?
Jaylen here yet?
Yep, I can see her. We need to get you off there. Perfect. Here we go. And Onse, if you can spot, perfect.
Thank you both.
Hi, everybody. We're delighted to be here, and we actually have some presentation slides. So I'm going to start sharing, Jaylen, if that's okay with you.
No, that's perfect.
And let's see, what am I doing here? Okay, and you should be able to see that presentation. So really fascinating conversation so far about impact. Azim's presentation about the reason for DEI is so poignant and resonating. And we have a different point of view as well, which, that's the whole point of diversity, right? Having lots of different points of views. So we're going to talk about the financial imperative of DE&I. And what we were thinking we would do as a way of creating a context for our time together today. We're going to do some brief introductions. We're going to talk about what our objective is and how we think about the continuum from academic to practitioner. And we're really treating this very much like a fireside chat. So we're going to be asking each other questions about our points of view, and hopefully that will engage you. And please put your questions in the chat as we've set aside some time at the end to address your questions. So I'll introduce myself, and then Jaylen will introduce herself. And I wish that I had used her approach for her introduction slide, which you will see in a second. But this is a little bit about me. I'm considered an expert in human capital analytics. My PhD is in board governance and the material impact of teams in the boardroom and in the C-suite. I've spent a lot of my career doing M&A transactions from an HR perspective. I'm currently a professor of practice at Columbia University, and I have my own consulting firm called HC Moneyball. And anyone familiar with the term Moneyball will understand that I'm all about the data. I gave you a couple of QR codes. One is for the book Humanizing Human Capital that Stella Lapouchore and I co-authored. And the other QR code is to my LinkedIn profile. And I hope that you will take the time to link into me and just write me a little note that says, saw you at DIRC, and I'd love to be connected with you. And Jaylen, see, I told you she has a much nicer slide than I do. One line.
No, I had more on my slide. Oh no, this must be a different version of the slideshow. That's fine.
Oh, I'm so sorry. I just went to our shared Google Drive.
And then probably downloaded it. No worries,
Yeah.
no worries.
I'm sorry. Do you want to share your screen? Do you have a slide that you want to share?
I'll just sort of speak to it. And then some of the links that I included like in my intro slide will also be down in the last slide. So it's perfectly fine.
Okay.
But hi, everyone. First off, I wanted to really extend a very warm thank you to Paolo for having me and having Whistle Stop at our first DIRC conference. Like I said, my name is Jaylen Spann, and I lead the sustainability research team at Whistle Stop Capital. Whistle Stop is a consultancy, and we help asset owners and advisors understand where there's a material intersection between social and environmental issues and their investments. So on behalf of our clients over the last few years, we've taken actions such as benchmarking the largest 3,000 US companies by market cap for their disclosure of quantitative data on their workforce. So a lot of the metrics that we've heard about today, those promotion rates, hiring rates, and retention rates, and then engaging with and encouraging companies to publicly share this data. We've also In some of our work, we've pushed companies to end their use of concealment clauses. So think non-disclosure agreements and arbitration. And with that, I am very excited to jump right into our conversation today. And I'll also echo that if anybody is interested in learning more or connecting with myself or anyone within Whistle Stop, please feel free. My email will be linked in the last slide, and then connect with me on LinkedIn if you see fit. So Solange, I want to really kick us off and talk about some of those academic foundations that are currently in place and some of the research trends that we're seeing. From your research and research performed by other academics, what have you found about the relationship between DEI initiatives and company performance? Walk us through some of those insights.
Yeah. So let me just back up for 1 second to say that what we want to talk about today for you as the audience is to explore this causal or at least correlational relationship between what we see in terms of the societal and the organizational impact of DE&I on sustainable financial outcomes. So we want to basically look at this continuum. So what is the academic community saying? How do we see this applied in practice? And then how do we actually know that the practice of DE&I is creating economic value creation for organization? And if you are a for-profit company, you're in the business of making money. That's how you exist. And so as an HR practitioner, you should be thinking about the ways that you can align and manage, acquire, deploy, align, manage, develop your human capital in a way that's actually creating economic value for the organization, for its stakeholders and its shareholders. And what we wanted to do is basically look at this continuum. So I'm on the academic side. Unlike Azim, I am not fully dedicated to the study. I am studying human capital, and from my background, it's materiality. It's how human capital drives material impact for organizations, and that's what I study and what I research, and see how that gets put into play in a practitioner's world. So I'm going to be talking a little bit about the first part of this continuum, and Jaylen is going to be talking from the practice to the financial outcome side. So how she consults with her clients, how she looks at the world through this DE&I lens. So, and I'm grateful for Azim showing all the academic foundings of this. What I'm interested in is the research that is directly related to the impact of DE&I to enhancing financial outcomes. So what proof do we have that focusing on DE&I actually makes a difference for the sustainability of organizations? And I just gave you a few of the very recent research in this area that shows that there is, in fact, a positive relationship between organizations managing DE&I effectively and their ability to generate either sustainable financial outcomes or sustainable market cap growth. So there is a lot of both academic and practitioner research. So we look at the McKinsey research, we look at Just Capital research. So it's not just coming out of the academic community, it's also coming out of the serious practitioner community that says that it does make a difference. What I did is to really understand how to take something that is an intrinsic or a qualitative signal of the organization and turn it into a quantitative signal like profitability or market cap. There are a whole host of human capital metrics that go to demonstrate the effectiveness and efficiency of investments in human capital in the aggregate as a macroeconomic indicator. The mother of all these indicators is something called human capital return on investment, HCROI. It is a metric that is embedded in the ISO 3414 standard. It has been studied in academic research for probably 30 years now. So it's been around, it's been studied. And if you look at the formula, you can see that there isn't anything that's qualitative in that formula. We're not looking at employee engagement. We're not looking at employee, workforce diversity. We're not looking at employee satisfaction or the investment in learning and development. We're looking at the financial return on investment in dollars spent on HR. And if I look at an HCROI, I can't tell you that HCROI is driven by learning and development or by diversity. I can tell you what HCROI is. I have to unpack HCROI to understand what's driving positive or improvements in HCROI. And you can see that really this is a financial algorithm that any business person can understand. Any CFO, any FP&A person, any controller, any treasury person, any CEO, so any board director. And really what we're looking at is the return on investment on adjusted profitability. So the formula is total revenue minus total operating expense adjusted for the total cost of human capital. That's every dollar that you spend on people, not just wages and benefits, but all your initiatives, your HRIS costs. And that numerator is basically an adjusted net income number. And then we take the total cost of human capital and we divide it into that, so that you can actually see that for every dollar I'm investing in people, I'm getting this adjusted profit number. And what we were interested in understanding is if we could see any trends between companies becoming more diverse and their HCROI, which is a precursor to profit. And it's a precursor to profit because it's a tautology of the formula for profit, which is revenue minus expense. So they go together. They are related to one another inextricably. And what we wanted to understand and also explain is if HCROI drives profitability, which we know that it does, the higher your HCROI, the better your profitability is going to be. I'm generalizing, but there'll be some exceptions. And what we wanted to see is there a correlation between diversity performance and HCROI performance? Now, this isn't causal, this is correlational. And we wanted to look at trends. We did this analysis for over 180 public companies where we could get EEO raw data. And I've just picked, 4 positive and 4 neutral to negative examples from the 180 organizations. And what we found was that this relationship is statistically significant in the data that we gave the model. So you can see that Adobe, American Tower, Caterpillar, and Costco, their diversity index, which is the orange line, goes up, which means year over year they become more diverse. Their HCROI, which is the blue dotted line, goes up, which means year over year their HCROI improved. And then we looked at their profitability performance, and where HCROI went up, for Adobe, their profitability went up 10%, American Tower 21%, and the like. Then we looked at organizations where diversity either was flat or went down. They became less diverse over that period of time. And you can see that in every instance, the HCROI goes down and their profitability goes down as well. So is diversity the only driver of HCROI? Probably not. Is it closely correlated to HCROI? I'd say in most of these instances, there is some type of a relationship between improved diversity and HCROI and flat diversity and declining HCROI. So if you don't really care, if you're not a humanist, if you're a pure capitalist and all you care about is making money, this is a very nice story that says the more diverse your employee population is, the more money you're going to make. So, you know, you don't even have to have some type of social context for this. Being more diverse makes you more profitable. So Jaylen, will you tell us a little bit about what you found in your research? And is this slide correct?
It is. Thank you. You know, and I really like how we led into it because your findings are really at least parallel to some of the ones that we've also found. Whistle Stop and our client, As You Sow, released a report last year looking at the link between management diversity and corporate financial performance. We started out by asking, you know, what and if there is a relationship between the financial performance at companies and their corporate diversity. So these two charts are kind of a lot. So I'll walk us through them. No worries. The first chart that we see on the side, where you see the green and the pink or red, if you're slightly colorblind, boxes. Thank you, Solange. If you look on the y-axis, you'll see the financial indicators that we chose to look at. And if you look at the x-axis, you'll see the sectors there at the top. So using a linear regression, we took a look at the EEO1 forms, similar to Solange, from 1,600 companies, okay? And at a high level, we found a positive association to cash flow, net profit, revenue, return on equity, return on invested capital, and long-term share price. So what that really all means is that a diversity benefit does exist and that companies are incentivized to be attentive and proactive in capturing it. Some other more granular findings that we found is that the higher percentage of racial diversity within a management team has been positively correlated to 8 financial metrics. And then conversely, and this is also a finding that one, I didn't know we were going to find. 2, I never hypothesized. And 3, I found very interesting. The higher the percentage of white male management, we actually saw a negative correlation across 8 financial sectors. So to the extent that we see positive components of diversity, there's also a negative correlation when that diversity is lacking and there's an excess amount or level of white male management. Another finding that we also found is that this positive correlation was really well defined, or I should say for those sectors that had the positive correlation, they were, that correlation was very well defined within the large cap companies. Now, this really speaks to those companies' ability and attention that they put into their human capital management practices, the attention and ability that they have to identify diverse talent, and the ability and attention that they have to setting up their infrastructure that they're going to need to be able to promote, retain, and hire diverse talent. So if you take a look at the chart on the left-hand side, the sectors that you see where they are green boxes, that is where we have found a statistically significant positive correlation between increased diversity within management and executive teams and financial performance for those specific financial indicators. Okay. The pink boxes where you see the negatives and the asterisks, those were actually sectors that we saw a statistically significant negative association between that link between diversity and these financial indicators. Now, I'll speak more to that in a moment. And then where you see just the pluses and minuses without the color, that's where we saw an association, that's where we saw a correlation, but not an association. And I'll speak more to how we're using these findings a little further in our conversation, and then also ping into the chart that's on the right-hand side. But Solange, I have a little bit of a follow-up question for you. Given the insights that both you and I just shared, how can companies sort of translate these findings into sustainable business practices?
Yeah, that's an excellent question. And one that I think is really important, especially for human capital practitioners to think about. I was a chief human resources officer for about 10 years of my career. For the majority of my career, I was a consultant and working with management, both HR, finance, and board level management. And one thing that is really absent for human capital practitioners is the ability to generate a business case around human capital impact. So HR practitioners will ask for a budget for a program, for a DE&I program, or for a learning and development program, or for a recruitment program, or a retention program. And they ask for budget, but they never actually create a business case around it. They never say that $1 invested in our retention program is going to avoid $3 in costs because we're going to lower our attrition, or $1 invested in a DE&I program is actually going to improve HCROI by 5%, which we know, because it's just math, is going to have an accretive impact on profitability of 200 basis points. So I think what's really missing and what's really critical is that we start thinking about these initiatives, these important initiatives, including DE&I, specifically DE&I, because there's so much evidence that of the relationship between improved diversity and improved sustainable corporate performance. That instead of asking for money based on, oh, we've got an initiative that we know is important for the organization, that we create a context for our budget ask based as a business investment. So we can show that $1 invested in a DE&I program is going to generate a positive return on investment and an accretive impact on profitability, so that it takes it out of the realm of the subjective and it puts it right into the realm of the objective or quantifiable. And I think that's, what both your research and my research shows, that in the end, organizations that do right do well. And this doesn't have to be a superstition or a belief. We have enough evidence to show, especially in the DE&I realm, that that is the case. And the faster HR practitioners can start thinking about investments in human capital as a business case, a business imperative that has urgency, that has relevancy, and that shows a return, the less we have to debate whether or not the programs are good or bad. Wouldn't you agree?
Yeah, I certainly would.
And we've got a lot of support now from the SEC, who has basically said investments in human capital aren't an expense. They are an investment in an intangible asset. Your CFOs are already thinking this way. They just need a little evidence from the HR side to help them cross over into the end zone in terms of, a winning play. Wow, a sports analogy for me. Can't believe it. Okay. Jaylen, do you want to talk about what you have here on table 9, or should we move on?
I'm going to come back to this actually. So you can actually leave this screen up
Okay.
Unless you want to move into something else.
Well, one of the things that we were just talking about was how to create a business case. So maybe we can go through this a little bit, and you can also speak to how you work with your clients around this. And then maybe we can come back to your other chart where you've got some real numbers in there that will help in supporting a business case.
That's perfect.
So one of the things that we were just talking about was creating a business case. So how do you do that? And here are 7 easy steps. Here's a framework for you to use to create a business case. Ultimately, what we want to show, what we want to communicate, is that the cost of an initiative is less than the benefit, the financial benefit that that initiative delivers for the organization. So when I teach this, I try to tell my students, think about things as they relate to your own life. So if you're having a hard time thinking about it as a business case, think about it as a financial case for your own life. Like you would never spend more money than on something than you think it's worth, right? So we often, I mean, that's how you make spending decisions, right? You go into a store, you see something that you like, in your mind, you sort of have an idea of how much you'd be willing to spend for that. And then when you find out that that item is either more or less than what you expect to pay or what you think you would be willing to pay, then your decision is made. If it's more than what you're willing to pay, you more often than not will say, no, thank you. If it's less than you were willing to pay, you go, wow, I got a discount, right? I have psychologically, I'm getting a discount because I would have been willing to pay more for that than they're asking. So you need to think about that when you present a business case to your management team. So the first thing you want to do is you want to identify the business problem or the business opportunity. And in our conversation, we are clearly stating that improving diversity in an organization is a business opportunity. It's showing that you're going to get better financial and better sustainable financial outcomes if you improve the diversity profile of your organization. You need to set a clear objective for the intervention and the impact on business outcomes. And one of the big mistakes that HR people make is they pick one number. They say, oh, if you give us $100,000 for this initiative, then we're going to drop attrition by 8% or by 6% or whatever number you pick. And my recommendation to you is that you always frame it as a range of value. So $100,000 should bring us, worst case scenario, 2% reduction in attrition, best case scenario, 4% reduction in attrition, and then calculate the benefit as a range of values instead of one number. This is for two reasons. One is your CFO has no way of really creating a context for what you're asking for. So he doesn't know if you say, 3%, if that's good or bad. What is the range around that? So if you go in with a range of values, your CFO will be better able to understand the sensitivity of the issue. And number two, if you go in with a range of values, you're more likely to be successful and hit the number within the range than having to hit exactly a number that you gave. So think about that range of values. Assess the cost and the benefits. The costs are easy because you know how much you're asking for. The benefits are a little bit harder to estimate, but there are ways of doing that. You can look at projecting an increase in HCROI by 1%, and then I've actually given you an HCROI calculator. I've also given you an attrition cost calculator. So you can see here HCROI and for materiality, and I've also given you an attrition cost calculator. So you'll want to figure out what the financial benefit is. Identify the risks and mitigation strategies. So if something goes wrong, if the intervention or the initiative isn't going the way it's supposed to go, what's your plan B? What are you anticipating to have to adjust or respond to before something goes wrong, right? So plan that out. And then present a compelling business case to the stakeholders. The other mistake that HR people don't do very well is create visual dashboards. We're really good at putting pictures together, but creating visual dashboards like this and like this, not a common practice for HR people. And if you are using visual representations and dashboards, bravo, good for you. Keep doing it and encourage others in the HR function to do that. So you can go to your executive management team with a business-based case grounded in evidence to support your ask to either continue a DE&I initiative or to establish a DE&I initiative. And you will get their attention. You will lose their attention if you ask for money and don't tell them the return on investment in that budget allocation. They will consider your budget ask a black hole, and they'll put it at the bottom of their list, and you will not get any funding. Right? The only way to get funding is to show that there's a return, and the return is compelling. So do you want to talk about this now?
I would love to talk a little more about how we work with clients to sort of implement some of the insights and some of the findings that I've shared from these charts.
Cool.
Yeah. So if you'll remember that this chart here that I just showed on the left-hand side, there were a few sectors, real estate, materials, utilities, and a little bit financials. They're on the cusp, but those sectors actually didn't realize a diversity benefit. The jury is still out as to exactly why. We're still sort of hypothesizing through that right now. In order to sort of hypothesize the why, we looked at, and let me also take a step back. So As You Sow has a racial justice scorecard that's sort of parallel to their workplace equity data scorecard that looked at 27 key performance indicators related to a company's racial justice programs, policies, impact, and disclosures. So basically, what are companies saying externally about racial justice? And we compared the sectors, when we compared the sectors that didn't realize that diversity benefit, we saw that those sectors scored lower than their peers across all of the criteria related to the racial justice management and strategy. So what that looks like on this chart, if you see, we actually put those sectors that don't realize that diversity benefit in the front, and you can sort of clear as day use your own eyes to see that. And I should also define what the gray and the orange means. The gray is where companies scored below the mean scores, and the orange is where they scored equal to or above the mean. So those companies within those sectors are not outperforming their peers. They're not being intentional about the way that they're speaking about racial justice. Or it could be that they're just not speaking about racial justice at all. These sector-specific findings really helped guide our engagement strategy for companies within this sector, because now we're really able to go to a company within the IT sector or the consumer discretionary sector and say, hey, it's important, to be intentional about your inclusion programs and the diversity within your leadership team. And if you are intentional about these things, you can see outperformance in indicators like free cash flow, return on equity, return on invested capital, revenue growth, and share price performance. In a perfect world, this type of assessment is one that we'd want to conduct across all of the inclusion factors, so across promotion rates, hiring rates, retention rates. I am a little bit of a data freak just by nature and also by my job title, but that would really be a data set that would be so vital to me, just because I like the data, but also because it's going to help us better understand exactly which policies and practices are the ones to keep and which ones are helping drive the impact that the company is trying to make, and which ones they should be leaning into, fostering, providing more funding for, and which ones may not be having the intended impact. Some of these insights were very nuanced, and there'll always be variables to consider, as with most research studies. And the nuance here is that more data is needed. That's really like the gist of it. When we first did this iteration of this report in 2022, we had 277 EEO1 forms to work with, a very limited sample size. And through a FOIA request, now we have more than 6,000 EEO1 reports from 1,600 companies between the years of 2016 and 2021. But even that's still a limited data set. So given these limitations with the data, we've really worked with our clients to engage with the companies and their holdings to push for the release of this data. And not just releasing the data in any old way, but in a way that is consistent, a way that is comparable to their peers, and in a way that tells us something material about that data set.
Excellent. I'm going to jump ahead to this slide. I've given you QR codes for two calculators, the HCROI calculator and the attrition cost calculator. And there is a comment by Lady Idos, forgive me if I pronounced that incorrectly, about the human capital practitioner's competency around knowledge, skills, ability, and cost at developing cost benefit analyses. So the trend, what we expect to see in the future is that human capital practitioners need to have some level of data literacy as a competency and some level of financial literacy as a competency. And those are the two classes that I love teaching at Columbia. I teach other things as well. In fact, I'm teaching the capstone now where I'm teaching our students how to actually build a business case using real life data and real life clients. So hopefully when they get out in the real world, they will have that experience under their belt. But if you go to the HCROI calculator or the attrition cost calculator, you'll have to give us your name and email. We just use that to build our mailing list. But any data that you put into the calculator is not kept anywhere. So that calculator is accessible. The data is not that difficult to curate or to understand. And we do all the math for you. So with the attrition cost calculator, you can start changing the assumptions in terms of attrition rate and time to fill job. And you can see what the financial benefit is of lowering your attrition or filling jobs faster. With the HCROI calculator, we show you what your current HCROI is. And then we tell you a 5% improvement in HCROI will generate a percent improvement in your profitability performance. Start with the HCROI. It's easy to use. It's easy to understand. It is super easy to communicate to your financial people. And those are the guys that hold the purse strings. They are your barrier to having your programs funded. So hopefully I've kept the slide on long enough that you've been able to go to each of those sites. And we'd like to take questions now. If anyone has any questions, you can either ask them out loud or put them in the chat, however you're most comfortable. And we've got a few minutes for questions.
I do also, before we hop into questions, I do, at least from the whistle stop side, want to clarify that, and I know we all hate disclaimers, but this is a conversation and sort of information exchange. All participants remain independent in their decision making, and that no data that we've provided here should be relied on to make an investment decision.
I'm actually going to jump in. So Les and I are going to actually jump in. So we normally, and I apologize, I didn't make that very clear. We usually don't do Q&A because the problem with Q&A is that we have 2 minutes left and not stop in 2 minutes. However, you happen to be right on the cusp of our next break. And our next break, one of the things that we do is that we open up a breakout room where anybody that wants to have any conversations can just jump into the breakout room. And so perhaps if you would like to, since we have actually 2 minutes left, first of all, we both want to thank you. Fascinating work. I really want to emphasize kind of the difference between some of the previous presentations that you heard that were more grounded in academic research and other kinds of considerations. This is really, I think, where the rubber meets the road, and seeing the two different approaches was very, very interesting.